is Alan Gassman. I am here with Christiana Mitchell, Peter Farrell, Christy Nicolo, Brock Heckerling, and Brandon Ketron. And it's nice to have partners when you go and you learn a lot of new material and you have to figure out what was important and what are you going to talk about. It's also nice to have partners when you're at home with the flu, which is my situation. And I was supposed to contribute more to this program than I have contributed, but I'm going to learn quite a bit. If you've never been to Heckerling, you should try it, even if you just show up on Monday and get the vibe of the World Marriott with 1,500 attendees, quite a large exhibition hall, and a lot of really, really nice people who are there to learn and there to meet others. There's no way in 1 hour that we can cover even 10% of the materials that were covered at Heckerling, but whether you went there or not, maybe what we're going to say and the spin that we might put on it will be of use to you. In about 2 hours, you'll get a copy of this video. You can send it to anyone you like, including the Pope, the President, your mother-in-law, anyone. And I'm going to hand this over now to Christopher Denicolo, my partner, who is going to CEO this corporate production.
Alan, thank you very much. And for those of you who have never been to Heckerling, we have here the agenda beginning on slide 2 that runs for the next few slides. And quite honestly, it'll take you a few minutes to go through each of these topics and understand and see the degree of sophistication and nuance that is presented at the Heckerling conference. So as Alan said, we will do our best to give you our spin and take on the nuggets we learned from there. But quite frankly, it's like drinking out of a fire hose when you're there because of all of the information that you receive throughout the week. So without further ado, we're going to get right into the substance here. And those of you who have been following along with the tax law are well aware that a very important and prevalent topic at the Heckerling Institute likely was the One Big Beautiful Bill Act, or OBBBA, as was mentioned at the conference. Sam Donaldson did our recent developments at Heckerling. He's fantastic as always. He's one part stand-up comedy, one part tax law, and he made the joke that "Oh Bubba" sounds great because it can be like, if there's something good, it's "Oh Bubba," or if there's something bad, it's "Oh Bubba." So one of the big changes as a result of the "Oh Bubba" Act was the changes to the qualified small business stock rules under Section 1202. Brandon, I believe you're very well familiar with these, and this is something up in your wheelhouse. So please, if you can, just give us a little bit of a summary on these changes.
Yeah, I think kind of big picture here is this was a favorable change to taxpayers. It's one of the items that was one of the favorable provisions of OBBBA. There was a few unfavorable ones that we'll get to later on in the presentation. But to talk a little bit about Section 1202, this is if you own stock in a C corporation and it's qualified small business stock, there's some rules related to the amount of assets it can hold, which increased under OBBBA from 50 million up to 75 million, and is now adjusted for inflation. So you get a little bit more room to be a small business. And the nice thing about Section 1202, historically, if you held that stock for 5 years or more, you could sell it and pay no capital gains tax on the sale of stock from the Section 1202 company. Again, it's got to be stock in a C corporation. It's got to be issued at original issue. None of those rules have changed. Now what did change is the holding period that you're required to have that stock is now, once you hold it for 3 years, you get a 50% exclusion on your capital gains. Once you hold it for 4 years, it's 75. And then the historical rule of 5 years or longer is 100% exclusion on your capital gains on the sale of stock. So you have a little bit of flexibility now with a 3-year holding period. You get a little bit of a benefit. The other change as we go to the next slide here is I mentioned the asset test moved from 50 to 75. That's now inflation adjusted, and the limitation on your sell. Historically, you could exclude 10 million of gain from the sale of stock. That's now been bumped up to 15. But one of the things that was talked about in Paul Lee's presentation is the 15 million is great, and the 10 million has historically been great. But remember, under 1202, the actual provision says that your gain exclusion is the greater of the 15 million or 10 times your basis in the stock. So another way to look at that is if you go right up to the limit of 75 million, if you contribute assets worth $75 million to a C corporation, or acquire assets worth $75 million underneath that C corporation, your basis is now the 75 million. You're still under the asset limitation, but your gain exclusion is 10 times that amount. So you can get up to $750 million of gain exclusion under the basis rules. So don't forget about that if you're doing Section 1202 planning, because it's not just the 10, 15 million, it's that 10 times a basis. And there's a lot of discussion in Paul Lee's outline of how he calls it packing, of how we can pack assets into the company to increase the basis and thus increase our taxpayer limitation above that $15 million kind of bottom line limitation that's in the statute. The other fun things you can do with Section 1202, and this is, Paul Lee recalls this stacking, is you can make gifts of Section 1202 stock. Your holding period carries over, and if you give that to another taxpayer, now they have their own $15 million exclusion. So if you're planning for a sell and you don't have enough basis, and you're in excess of the $15 million, you can gift this to non-grantor trust for the benefit of each of your children and create separate taxpayers, and stack your 1202 exclusion to a number of different taxpayers. If you have 3 kids, you set up a trust for the benefit of each of those children. They're all different taxpayers under non-grantor trust, and you get 4 $15 million exclusions by making those gift transfers. So there's a lot of fun things you can do with 1202. It's a nice income tax benefit. And Paulie gave a great, discussion of the recent updates, as well as some planning techniques that you can use in 1202 planning.
Brandon, was Paul saying, or his outline seems to say, that you could have an entity taxed as a partnership, and then if you don't have liabilities exceeding basis of assets, you could transfer that LLC taxed as a partnership into a C corp, and then the tacking period would start back when you started the partnership entity?
I don't think that's the rule, but I'll have to read back through Paul's outline. I think you have to start a new, I think he talked about that in the sense that you might be like, under the rules, I think you get a tax holding period, but under 1202, there's a special rule that you have to restart from the day you created the C corporation. So that technique doesn't work unless I misunderstood.
Yeah, that's something to write about for sure.
Mm-hmm.
Brandon, just to bring it back to fundamentals here. So 1202 stock and the benefits afforded by this section applies solely with respect to the sale of the stock itself, and not with respect to the assets being sold under the C corporation. Is that correct?
That's correct. And that's one of the issues that you can run into with Section 1202 is you can set up, this perfect C corporation that qualifies under Section 1202, and then you go to a buyer and they only want to buy assets and not stock because of, they don't want to carry over the unknown liabilities by, taking over the stock of a company. They want to buy assets, and there's basis, benefits for them in buying assets as well. So that is something to be aware of with Section 1202, is that it only applies to stock sales. So you have to find a buyer willing to buy the stock, and you may have to adjust the purchase price to get them to buy the stock, knowing that you'll have exclusion of gain and come to a net better tax result for your client.
That's right. That's right.
Brandon and I are working on an arrangement right now where the intellectual property for a business is going into a 1202 C corp, and that's going to be a trader business. The other business is going to pay the intellectual property company for the use of the IP and to develop further IP. And then eventually when the entrepreneur goes to sell both companies, he'll be able to allocate with the buyer allocate as much as possible to the intellectual property company and as little as possible to the other entity. And in the meantime, we're getting the benefit of the 21% bracket under the 1202 company, and it will reinvest the royalties it receives in legitimate business arrangements. So just the 1202 as an add-on management royalty company, and then the buyer may not mind paying some money for that stock because there's probably not going to be any liability or significant liability risk if they empty it right out and then own the IP.
Good point. And I think the other thing to aware of the 1202 is it does have to be an active trader business. There's particular industries that are excluded from the 1202 benefit. They're the same ones that apply under section 199A, if you're familiar with those. 199A actually references 1202 in determining those ineligible trader businesses, but generally it's health, law, accounting, engineers, kind of more professional services are excluded from this benefit, but there are a significant number of businesses that do qualify.
That's right. All right, so last nugget here on qualified small business stock involves the step up in basis. Now, as I interpret what Paul was saying here is that if there's a step up in basis in the stock that is received as a result of the death of a decedent who owns the stock, the 10-time basis limitation still calculated without that additional basis that applies as a result of the step up. So, in essence, in Brandon's example, if there's $15 million of basis and that's appreciated to $75 million when a decedent dies, the step up in basis to the recipients would conventionally be $75 million under section 1014 of the Internal Revenue Code, but the 10 times limitation applies with regard to the 15 million and not the 75 million, right?
That's right. It's your date of contribution basis that's relevant for determining this 10 times basis limitation. And like it says here, you can't, any adjustments to basis after that date by reason of death doesn't impact your original 10 times basis amount.
And that can be important for those clients who are have C corps and do want to pass businesses down to the next generation and take use of this step up in basis. All right, so the next slide here, Alan, we have a citation for both you and Peter and an article written by the two of you and Nick Tibbetts of our firm here. Do you want to speak a little bit about the discussion of the case here that's cited?
Well, Peter wrote this, so I'm going to let Peter have the discussion. I just took credit for the article.
Oh, Peter, you're muted, sir.
Peter. You're muted, Peter. Peter, you're muted.
Click the button on the
Those
screen.
of you who can read lips.
First time on Zoom. I was going to say attorneys we're very humble, and we wouldn't dream of highlighting our names being in an outline, but just for the benefit of everybody, we want to highlight this particular case, which did show up in the recent development section. And this case that Alan and I and Nick Tibbetts, who's currently in the LLM program at the University of Florida, go Gators, wrote together is an interesting case, and it's about making sure that when you do intrafamily loans at the applicable federal rate of interest, we know under section 7872 that's a safe harbor for gift tax purposes, that you can, as in this case, it was a mother making about $2 million loan to her son at the applicable federal rate of interest. The son made a couple payments, and unfortunately his mother passed away. The outstanding balance of the note was included in her gross estate for federal estate tax purposes, so that was done correctly. But the IRS issued a notice of deficiency saying that at the time that the loan was entered into by the mother and the son, that actually a gift was made, because the parties never intended to actually enforce the terms of the note. The son never intended to repay his mom. The mom didn't expect to be repaid. Well, one of the things that Sam Donaldson, whoever wrote this portion of the outline, points out is that it does seem like the IRS has made a mistake here in the notice of deficiency. It may have just been copied and pasted from another one, because in this case, the son did actually make the note payments, and of course the interest was under that safe harbor under 7872. And so the taxpayer won in this case. The court looked at a number of factors, which you can see listed on the screen in the first paragraph there. There's 9 factors, the things that you would think of to have a bona fide arm's length obligation, the evidence of a note, that there was security, there was a fixed interest rate, payments were actually made, the borrower actually had the ability to pay. There are several cases where, and I think in the outline, Sam Donaldson over made an example. If you loan $100,000 to an 18-year-old who doesn't have a college education, doesn't have a job, has a AI chatbot girlfriend, it seems like he's unable to pay. That's probably not a bona fide loan, and probably is a gift at the time of the transfer. We, in our article, looked at another case, the Miller case, where under similar situation, the court found that this actually was a gift at the time of the loan was made, because they didn't have all of those things. There wasn't, I think, in that case, actually a written instrument, for instance. And lastly, one thing we point out in this article that was discussed a little bit in the recent developments panel is the fact that there is a little bit of a disparity between the safe harbor of the AFR for gift tax purposes and as a safe harbor in the valuation of a note for federal estate tax purposes. There's a little bit, the last paragraph, the panel pointed this out, in 7872 says that the Treasury can issue regulations regarding the estate tax treatment to sort of match how it is in for gift tax purposes, but there have never been regulations issued. So there doesn't seem to be any good law now that would say that the AFR is a safe harbor for federal estate tax purposes. So anything else to add about that, Alan or Brock?
No, I think it's just another example of where you have to have a promissory note, you have to pay interest, you have to follow the formalities. And even in this situation, when they did all of that, the IRS still came in to beat them up. The borrower here was not able to repay it, but they knew he was going to inherit it. So as to collectability, you may be able to get away with that, but otherwise, and try to have collateral if you can. So what's next, Chris?
Well, next is this wonderful presentation, at least I thought so, on charitable remainder trusts by Kelly Helmuth that was given on the first or second day, and she gave us a really nice survey of the landscape of charitable remainder trusts. And one of the interesting things she said there was, look, the IRS has these forms that say here's an acceptable charitable remainder trust, but those forms may not necessarily produce a result that is intended, right? These forms might need some tweaking and might need some review and analysis. I know when we prepare our charitable remainder trusts, we have a different form that largely takes from the IRS forms, but does add a few more bells and whistles and protections to help assure that the clients have the intended result with their charitable remainder trusts. The outline does give us a good checklist of what to cover. Now, charitable remainder trusts are very much a blank canvas in that you can structure them in a variety of ways. If you have, for example, a situation where the grantor is utilizing a charitable remainder trust primarily for income tax planning purposes, and the grantor does not necessarily have concern for estate tax planning, then the grantor can be the trustee and can have powers to replace the trustee and can even receive non-charitable payments, with the whole scope of a charitable remainder trust really being assets are transferred to the trust over a lifetime or term of years. Payments are made from the trust back to the grantor or to a desired beneficiary, and with the remainder interest going to charity. So it is a very nice tool that can be used not only for income tax planning, but estate tax planning purposes. Peter, I know we had a talk on Sunday before Heckerling, and you did a fine job reviewing this slide regarding the charitable contribution rules. I would do it grave injustice without you here, sir.
Yes, and there's hundreds of people there. They all heard, so I'm sure you've already heard this. It was the talk of the town at Heckerling, but I'll also just go over this briefly. It is a development. It was covered, I think, also briefly in the recent development panel, which are the changes to the income tax charitable deduction rules. The slide on your screen is one we've used before. They're really only the orange in the bottom left is the only thing that's new. So I'll mention that now, which is starting this year, there is a $1,000 deduction for cash contributions made to a public charity that applies only for non-itemizers, those who are taking the standard deduction. And it's $2,000 for a married couple. So that's great news for them, and that's pretty much the only update for non-itemizers. Now, everything you see to the right here is were rules that were already in existence. I won't go over them, but they're the thresholds for the AGI limitations on contributions to charities. And you can see it, there's a different percentage based upon what was given, whether it's cash or not cash, and the recipient, whether it's a public charity or a private foundation and so on. And you can see those there. And then remind you on the right-hand side, one of the greatest things you can do in terms of for charitable giving, if it applies to you, if you're over 70 and a half, you can make qualified charitable distributions from an IRA, which is a great planning technique if the client wants to make charitable contributions. So here, the next slide has the things that are new, and of course you can. One thing I'll mention: if you're limited by one of those AGI limitations, you can carry forward the disallowed amount over the next 5 years. So this slide is a fish tank, obviously, and it helps to explain the new income tax charitable deduction rule. So at the bottom, and some of this was cut off by the footer. I apologize for that, but we have that $2,000, $1,000 cash contribution to a public charity for non-itemizers. Now, when we the next step is that the $32,200, which is the standard deduction amount. And so one thing we just point out there is that this, as an example, if a client has non-charitable itemized deductions of, in this case, $22,200, and makes a charitable contribution is $100,000, that couple effectively loses $10,000 of their charitable contribution because they can just take the standard deduction. They don't actually need the additional charitable deduction for, at least for tax purposes. It may be a good thing to do, but they get no tax benefit from that. One thing that was added is a 0.5% floor to the income tax charitable deduction. So a taxpayer cannot deduct the first 0.5%. So if a taxpayer has $1 million adjusted gross income, you can't deduct $5,000 that you'd otherwise be able to deduct as in income tax charitable deductions. Now, one thing to point out, that's pretty de minimis. Everybody wants to get a bigger deduction, but maybe something, if you're talking to your clients about this, it is relatively de minimis amount. Now, one thing to mention about that is you can carry forward the disallowed 0.5% if you have a carry forward from the previous slide. So if you were limited by 60% of a cash contribution to a public charity, you're carrying forward the disallowed amount over 5 years. You can continue to carry forward the disallowed 0.5%. But remember, unless Congress changes the rule, you're going to have that 0.5% limitation next year, and the next year, and the next year. So you really don't necessarily benefit too much from the carry forward.
Now, Peter, this 0.5% limitation, this is completely different from the wretched 237th rule, if I'm not mistaken.
You are not mistaken. It is.
Okay, so let's hear about this. You know, I don't think we've ever heard of the fraction 237ths being used outside of this, but please tell us what it is and why it's such a pain.
All right, I'm going to start it, and then I'm going to hand it off to Brock. He has some additional comments about it. But to explain it in the most simple way, without getting into the mechanics of how it's calculated, first of all, it only applies to taxpayers in the highest tax bracket. So that's a 30% tax bracket, and Brock will, which is I think around 600,000 of income. An individual taxpayer be in that bracket. Brock is going to mention, he's going to talk a little bit about whether this applies to trusts and estates, and we know that the threshold for a trust and estates is much lower. But for taxpayers in the 37% tax bracket, and this applies not just to the charitable deduction, but to other itemized deductions, you are essentially put in the same place you would be if you were in the 35% tax bracket. So your tax is though you're in the your tax on the additional income in the 37% tax bracket, but your deductions would be as if you're in the 35% tax bracket. It doesn't just apply to charitable deductions, but it does apply to charitable deductions if you're in that 37% tax bracket. Now, has been over the months since OBUBA was passed, questions about whether this 237th limitation applies to trusts and estates, and that was definitely discussed at Heckerling, and Brock is going to discuss that now.
Yeah, so I think, just more generally here to learn a little bit about this 237th rule. It applies to all itemized deductions. So this is an across-the-board reduction of itemized deductions. Now, the language of the code is really saying it's 237ths of the lesser of either your total itemized deductions or the amount of taxable income above the point where the 37% bracket begins. But I think the easiest way to look at this is, 237ths is about 5.4%. This is a 5.4% haircut on your itemized deductions once you're in the top bracket. So the question that came up at Heckerling that really interested a lot of the practitioners was whether or not the 237th limitation applies to trusts and estates, specifically as this would impact the distribution deductions available to the trusts under 651 and 661. So under the previous version of IRC 68, we had 68E, which explicitly told us that any estate or trust, the 68 did not apply to any estate or trust. But the newly passed 68 repeals 68E. So the question becomes whether this new rule is going to apply to expenses which would not have been incurred but for the property being in a trust, which some people refer to as unique administration expenses, the 642B exemption, as well as the 651 and 661 deductions. Now, in the recent development talks, Turney Berry, Samuel Donaldson, and Carlin McCaffrey said that if you're just looking at this from a purely statutory standpoint, 68, they said trust and estate practitioners will probably have to grapple with 68 with respect to these items. And that's because if you just walk through the code, 68 applies to itemized deductions. 63 defines itemized deductions as all deductions in Chapter 1 except for above the line deductions under 62 or those listed in 63B. Now, 651 and 661 are not listed in 62 and also not listed in 63B, which led Carlin McCaffrey and others to come to the conclusion that these distribution deductions would appear to be itemized and therefore subject to the 5% haircut. Now, what would this look like is it would potentially create a double taxation problem. You can see on the slide here, I've quickly ran through an example that shows that if in 2026 a trust earned $1 million and distributes all $1 million out to the beneficiaries, normally subchapter J acts to either tax the trust on the income it accumulates or tax the beneficiaries on the income it distributes. And that's 651 and 661 deductions function right there. But if we were to apply the code literally here and give a haircut on the 661 deduction, the trust would effectively be taxed on $53,000 of income that it also distributed and the beneficiaries would incur tax on. So it's an interesting little code quirk that Congress probably didn't think about when passing OBUBA. But thankfully, we may have some regulations under 67E, which might help us a little bit here. And under 67E, we have regulations that specifically provide that an estate or trust essentially computes its income in the same manner of an individual, except for a couple certain items, including 651 and 661 deductions, which the regulation treats as a deduction in arriving at adjusted gross income. In other words, an above the line deduction. Now, the contrary argument to the application of this regulation to sort of save the day on this weird quirk would be that 67E itself says for purposes of this section. So arguably, the administration of this regulation could be contained to dealing with the 2% limitation on miscellaneous itemized deductions under 67 and not save the day on 68. Now, the recent development outlines did make a note, however, from a practical standpoint, that the IRS is unlikely to impose an interpretation that will result in a double taxation. And you can see the quote there that I've given at the bottom of this slide. And they essentially say the IRS is very unlikely to take a position resulting in double taxation and will likely stick with the regulation approach in allowing those not as itemized deductions, but as deductions in arriving at adjusted gross income. So we'll see what happens. Definitely fiduciaries and practitioners could use some guidance. Hopefully the IRS will confirm that they will use the regulation on this issue, or Congress will correct this with a technical correction to OBUBA.
Yeah, just from a high level, Brock, it seems like this is a technical quirk that was not thought out with the drafting that likely will be resolved. But who knows? Because we also have another little quirk here when it comes to whether this 237th limitation applies to the charitable deduction applicable to non-grantor trusts. Specifically, under Internal Revenue Code section 642C, there is a charitable deduction available to a non-grantor trust without any limitations for adjusted gross income. And this was a wonderful charitable planning technique that planners have used for decades to get full charitable deductions for income paid or set aside for charities. Brock, what do we think about this 237th limitation and how it might affect that charitable deduction?
I think again, we run into a lot of the same little statutory quirks I was just describing. And we also have this additional without limitation language, which adds another path for analysis here that I think Brandon can expound on a little bit more. But I think, and initially with respect to the 651 and 661 issue, I think practitioners would be reasonable in relying on the regulation to not file the fiduciary tax return in such that there would produce a double taxation result before guidance is issued. And we'll see if guidance is issued in the near term that can solve that issue. And the 642C question is similarly in the same vein.
So I think kind of to add a little bit more color here to this is, traditionally trusts that have language in the trust document or in the will or estate document that allows for distributions of income to go to charity, trusts have been able to deduct that amount from gross income. Kind of complying with the same concept of subchapter J is either the trust pays the tax or the person who you distributed the income to pays the tax. And in the case of a charity, that's non-taxable. The 237th limitation creates an interesting problem here. If it does apply to trusts and estates, does it also apply under section 642C in that we would lose 2/37 of that distribution to charity? And the interesting part is there's some unique language in section 642C that doesn't lie in other sections that might be applicable to trust and estate deductions. 642C says that the deduction is taken, quotes, without limitation, close quotes. And there's two kind of conflicting views here. The recent developments panel, kind of indicated that they thought the without limitation was really meant to apply to the AGI limitations that apply to individuals, and that trusts aren't subject to that. they get the full deduction for any income distributed to charity. We've taken a contrary position to kind of basing it on some case law, and that's explained in this Lissy newsletter that I referenced at the bottom of the slides here, that if Congress intended without limitation to apply solely to the AGI limitations, Congress would have been explicit in saying that. It seems that without limitation truly means without limitation to any limitation that might apply to charitable income tax deductions given by trust in the states. And thankfully, Clary Red seemed to agree with us in the wrap-up session in this regard, and he made the quote that 642C in the without limitation language creates irreconcilable conflict. So you have one section that says it's limited, and 642 says it's not limited. So which one applies here? He kind of seemed to agree that if they wanted to limit section 642C, they would have had to specifically say that, because otherwise 642C says without limitation. And that language would override any other limitation that might apply, including the 237th, new limitation that was imposed under OBUBA. So I think there's still a little bit of, there's not really any clarity here as to what does apply, but I think you do have a supportable position that if you make distributions of income to charity, you get a full deduction for that because of this without limitation language. Until we get official guidance from the IRS, we can't be sure, but I don't think it's a position that would subject us to any penalties, or it's definitely reasonable reliance upon the actual language of the tax code itself. Now, both presentations, the recent developments panel and the wrap-up presentation, made the note that one workaround this 237th limitation could be used in section 678. Under section 678, when an individual or a charity or another trust has the right to withdraw income, and they either exercise or let that withdrawal right lapse, because they had the right to withdraw that income, they're now deemed to be the owner of that income for income tax purposes. So if you give a beneficiary the right to withdraw income rather than leaving it in the discretion of a trustee to distribute income, the income should be taxed to the beneficiary under section 678, and you don't have to worry about losing a haircut on a 651 or a 661 D&I deduction. And the same concept could apply to a charity. If you give a charity the right to withdraw income, now the charity is deemed to be the owner of that income, and you get the equivalent of it a deduction because the charity doesn't pay tax on that income. So I guess drafting example would be the charity. My alma mater would have the right to withdraw $50,000 a year of the taxable income of the trust, in which case that charity, my college, is now the deemed owner of that income, and we're not even worried about section 642C. So if this does come into play, and we are incorrect in our position that the without limitation doesn't save the day, section 678 may be a workaround that we could use to make this not subject to any haircut.
Well said, Brandon. I tend to agree as well. I'm glad to hear that the community at large seems to agree with us in our position, but we'll see if the IRS gives us more guidance. So another great opportunity, pun intended, are opportunity zones, which was, if I'm not mistaken, released as part of the 2017 Tax Act as a mechanism where investment in certain zip codes in the United States could allow taxpayers to defer previously incurred taxable gain going forward. I don't recall who was going to get into this a little further, but I'm happy to do so if nobody else, if that's, we didn't designate this.
Good. Go for it, Chris.
All right, let me see if I can shoot for this. So, previously, if there were capital gains incurred by a taxpayer, the taxpayer could, within 180 days, defer those gains until December 31, 2026. Now they've effectively extended that December 31, 2026 deadline for 5 years. So the gain would get recognized after the end of the 5th year, unless it's in another type of opportunity zone, which is a qualified rural opportunity zone. Now, keeping in mind, the investments in these qualified rural opportunity zones have to be for longer than 5 years, and there's an additional basis increase as a result. So from a policy standpoint, it is intended to encourage investment into these certain rural opportunity zone areas to give taxpayers another carrot, so to speak, to put capital into these areas. We have some clients who have made use of these opportunity zone investments. I would suggest that you review the geography of where these are, because some of your clients, I suspect, may already be investing in these areas. So it's just something that we can explain to our clients as a possible tax planning technique. We also have guidance on what the IRS will no longer issue rulings on. One of those items is when a taxpayer donates property to a public charity and does a leaseback transaction where they can use the property after it goes into the charity. This obviously is an area ripe for abuse. So the IRS is going to look at this on a specific area if there's a reporting made with respect to this type of transaction, as opposed to an advisory type situation like where a taxpayer would request a private letter ruling so the IRS can bless the transaction before it happens. Much to the chagrin of me, at least, and some other planners out there, the IRS will not rule on certain Section 678 transactions, including what's called a BDOT or BDIT transaction. And just to get us into the summary of what that type of transaction is, as Brandon mentioned, Section 678 of the code allows a beneficiary of a trust to be considered as its owner for income tax purposes. So many years ago, sophisticated planners came up with an idea where, for example, I put or I have a parent, for example, fund a trust, give me the right to withdraw assets from the trust, maybe limiting that to $5,000. I am then the deemed owner of the trust under Internal Revenue Code Section 678. I can now sell my appreciated assets to that trust in a normal installment sale to a grantor trust transaction, pay no income tax on the sale, and now I have these assets held for my benefit outside of my estate for estate and gift tax purposes. Well, the IRS says we're not going to give you an advisory ruling on this, which, you know, it makes sense because it's somewhat controversial. I don't think we have the authority on these types of transactions that we're all looking for, the safe harbor. So it is interesting to see that the IRS now has it on its radar on the do not rule list. Those of you who have been following OBUBA and the main driver and the main cause for celebration, at least for me, given that I did not have to live in this office in the month of December 2025, were that the estate and gift tax rules have changed. And the biggest thing now is the estate tax exemption, the estate and gift tax exemption, that is, has now increased permanently to $15 million per person. And I use air quotes around permanently because we all know in the tax law, permanently means until they change it again. So who knows what the law will be in the future, but for now and for the foreseeable future, we have a $15 million per person exemption amount. We also have small increases on the highest tax bracket for estate and trust income tax brackets. Now we're about $16,000 of income as opposed to $15,650 of income in 2025. And the marital deduction for gifts to a non-citizen spouse now increases to $194,000 from $190,000 where it was in 2025. Clary Red also gave us a really nice discussion of portability allowance and how that has changed over the last few years. Many of you are aware of revenue procedure 2022-32, which gave us a little bit more time to file a portability estate tax return. And what is a portability estate tax return? Well, if I die, for example, with assets below the estate tax filing threshold, which would be 15 million less gifts I've made if I died in 2026, and if my spouse wants to file an estate tax return for my estate so she can get use of the increased exclusion amount that I didn't use, under prior law, it was 2 years from my date of death was the rule by which the estate tax return would have been filed. Well, now under this revenue procedure, it's a 5-year period. And that continues to be the law of the land, which is great for planners, especially if you have 2 elderly clients, one of which who died below the exemption amount, and you're considering whether you should even file a portability return for the surviving spouse. Well, if the surviving spouse doesn't survive the 5-year period, then there really wouldn't be a need to file the portability return unless the surviving spouse's estate would exceed the exemption in that year of death. So good to see that blessed. But there's this roll-in case out there where the IRS said a portability estate tax return that was filed was not adequate to allow that unused portability or the DSU amount, the deceased spouse unused exemption amount, to be ported over to the surviving spouse. And here's why. The initial filing did not comply with a fully completed and appropriately filed federal estate tax return, which requires valuations, it requires certain disclosures be made, certain responses be made to questions on the form. There is an alternate streamline approach under a Treasury regulation that I can't recall the site, but it's right there on the Form 706. If assets pass outright and free of trust to the surviving spouse, then those assets do not necessarily need to be valued and they can be estimated, right? There's like a special use valuation. Please keep in mind that special rule doesn't apply if the assets go to a trust for the surviving spouse. So if you have a situation where the first spouse to die has assets in trust that would divide into or go into a credit shelter or marital trust for the surviving spouse, you're not going to be able to use that special valuation rule. So the moral of the story here, the net is, if you have clients who want to do portability estate tax returns, you have to tell them it's a full bore estate tax return, except as to the assets that go outright to the surviving spouse. So keep that in mind, because in this case, in the roll-in case, the taxpayer didn't even put values on some of these assets, right? And the IRS found that the lack of valuation, lack of compliance was not adequate to generate a portability filing requirement, which could be problematic, right? It nullifies the reason why you would even file the return in the first place. So it's worth reading and worth understanding. Another topic that had some traction at Heckerling was this idea of Q-tip trust termination. I'm not sure who's supposed to pick up this discussion. Anyone?
I can kind of comment a little bit on this one. And basically, there's two cases out there right now, Annenberg and McDougall, where they did clients did some planning with an outstanding Q-tip trust, and essentially what it comes down to is the IRS has been trying to apply Section 2519 to any type of planning that you do with the Q-tips, and the tax court has kind of slapped their hand a little bit on some of these cases. Essentially what the IRS is trying to say is that when 2519 applies when you dispose of your income interest in a Q-tip trust, you're deemed to have made a transfer of the entire interest of the trust. So it's a really bad tax result. You can't just bifurcate and commute a Q-tip trust. 2519 is designed to prevent that from happening. But in these situations, the Q-tip trust was essentially terminated and the assets were all given to the surviving spouse. The IRS tried to claim there was some sort of gift made by the surviving spouse by virtue of giving up the income interest. And the tax court kind of said, well, wait a minute, how can the spouse made a gift? The spouse got all the property. They're in a better position than they were before they had this trust. So if anything, the remainder beneficiaries might have made a gift. And so that was pretty much these two cases. So it does allow us some flexibility now with planning with Q-tip trust. The IRS or the tax court is kind of blessed if you make sales of interest in Q-tip trust, that's going to be respected because the spouse still has an income interest in the promissory note owed back to the trust. That's not disposing of your interest in the Q-tip trust. The one interesting part, and this is particular to the McDougall case, is that this aspect of, well, if the spouse doesn't have appropriate discretion under the trust to receive all the assets and the remainder beneficiaries have consented to let the spouse get all the assets, are the remainder beneficiaries making a gift to the spouse? And the tax court said, we think so, but we don't know how to value that gift. Basically, they kicked it to a valuation expert to determine a value. And this is a situation where the remainder beneficiaries could be divested with a limited power of appointment. So they might receive income upon death of the spouse. They might not, depending on whether the spouse exercises that power. So what is the remainder interest worth to a particular beneficiary? That's what's being kind of thought now with a valuation perspective in McDougall. And so that'll be interesting to see how that turns out, is what is the true value of a remainder interest that's subject to divestment? Because you can't really value that with actuarial factors. There's this unknown aspect of the potential for divestment there. So we'll see how these play out.
Yeah, really interesting point, because another thing that was mentioned by Diana Zeidel at Heckerling was, even if you have a discretionary trust, forget the spouse for a second. If, for example, I'm a beneficiary of a discretionary trust, I can receive distributions only as Peter, as trustee, decides to make distributions for me. But I also have a lifetime limited power of appointment to appoint these assets among Brock, Krishana, and Brandon, and I exercise that power. I've been deemed to make a gift, right? Under some of revenue ruling, I think it's revenue ruling 79-327, and Diana Zeidel mentioned that, but that falls back on what Brandon just said. How do you even value that, right? If I can't receive this distribution, if I can't compel it unless Peter decides to make it for my benefit, the fact that I exercise this power of appointment in favor of Brock, Krishana, and Brandon, you know, how much of a gift did I make, right? It's how much am I really giving up? And I think that's just a battleground that we might look at in the future and see if the IRS wants to challenge. This is about as good a time as any to jump ahead to another battleground, an old battleground that's been rehashed here, and this involves last-minute transfers, particularly in the discount arena. So those of you who are familiar with, the likes of Powell and Strange from the days of yore, these are similar situations where assets are contributed to an entity, and then interest in that entity are gifted or transferred a short period thereafter. What is the true value of the valuation discount that applies to these interests? And of course, in Strange, the IRS found that the discount should be lower. There's also the Holman case from, I want to say, about 15, 20 years ago. Here in the Fields case, there was a situation where a limited partnership was established on the last minute under power of attorney about a month before the decedent died. There was a gift made, and that gift was made with a combined discount of around 35%. The tax court looked at the factors here and said, look, there's no real substantial non-tax business purpose. And one of the big things I've always remembered from going to Heckerling for many years here is, when you set up these entities, make sure you document a substantial non-tax business purpose as to why you're doing so. Paper the file with it. Paper the file as to why you're doing it. Get a good qualified business appraisal. Don't just rely on a back of the napkin math. Don't have the clients bully you into saying, look, we're fine with just using the value of what it is. And what did you say? A 30% discount? We'll just apply that at the end. If the clients want to do that, make them sign a letter acknowledging the risks associated with the valuation or something, right? Disclose to them these possible risks, because the IRS seems like it's not going to give up a fight on these issues. I'm just going to point out here, we have the Fields case in its entirety set forth over these next few slides. I'm not going to go over it, but it's here for your own edification. It does provide for interesting reading, because this is an area that we could foresee the IRS challenging, particularly now that the exemption amounts are so high that revenues aren't going to be what they were under the estate and gift tax arena. All right, so we have farming deduction and contribution rules. Who's going to touch on those items?
I'll quickly handle this. It was just a recent development case that was mentioned. It's a 2022 tax court decision. I think this was understood to be the law, but when you have inventory property or property that's going to produce ordinary incomes in the hand of the taxpayer, you're not going to get a charitable deduction by transferring that to a charitable remainder trust or directly to the charity. That's going to be an assignment of income issue, and you're not going to get your deduction there. So I don't think this was anything new, just kind of confirmed the understanding here. Ordinary income property in the hands of a taxpayer in particularly inventory, is not going to get a deduction for a contribution to a charitable remainder trust under these facts and circumstances here.
All right, so another topic that came up was the idea of using reciprocal slats. So just as a basic here, a slat is a lifetime trust established by one spouse for the benefit of the other spouse. They are very common and were increasingly common as the exemption was set to sunset in 2026. They're still relatively common, despite this now permanent exclusion amount. And one hot button issue is whether the spouses can set up slats for each other, right, or reciprocal slats. Now, we are reluctant to do that type of planning because under certain cases out there, the IRS has uncrossed the slats and said, husband has set up a trust for wife and wife set up for husband. We're going to consider them as having set them up for themselves and nullify the estate tax issues, estate tax advantages of setting up such a trust. Additionally, there is a creditor protection state law reciprocal slat issue that needs to be considered when setting up these types of trusts. Well, Clary Red said that he thinks it's possible to have reciprocal slats if you follow some of the factors that were presented in the Levy case, things like different trustees, different time of creation, different distribution standard, things like that, right? So this is a topic I think that is becoming increasingly more common and more prevalent. Alan, I'm interested in your thoughts on reciprocal slats and whether you think that they're still not a great idea.
Well, I try not to do reciprocal slats, or if we do, if one spouse does a trust for the other spouse, we just try to have the other spouse do a trust for the descendants. Maybe put a provision in there that if everybody's net worth goes way down, there could be a way to reach into the trust, have it be a domestic asset protection trust, but we discourage it. And most clients just don't need it economically. So there was another great discussion, by the way, on slats and divorce, and lots of discussion of divorce this year at Heckerling. I guess estate tax is out. More people need to get divorced now. But, thinking through your slat so that if you do get divorced, who can benefit from the slat? What happens with the slat? That was another, good topic to cover. I'm going to, while I'm on this slide, I'm just going to go ahead and also mention there's 11 states listed there that allow you to do a joint trust that's not a tenancy by the entirety situation. It's not with right of survivorship. It would fund a credit shelter trust on the first death, yet it will apparently be creditor protected as if it was a tenancy by the entirety's asset. So that includes Illinois, Maryland, North Carolina, Tennessee, Virginia, and Wyoming. Now, nobody's really sure if this would work in bankruptcy. So I would be careful with this and don't think it works in any other state. But it was something that I thought was very interesting. I'm sorry if I took too much time up, as I see that it's almost 1 o'clock.
No, not at all, Alan. We tried our best to go through everything, but those of you who have been with us for a while know that we tend to put a lot of information in these presentations. If nothing else, it's a good desk reference. And as I said earlier, Heckerling is like drinking from a fire hose. The degree of information is really just very broad, very detailed, very deep, very much beneficial. And as you mentioned, Alan, some of the planning for slats was really focused here, including things that need to be addressed when approaching clients with slats, right? What are their goals? How much do they want to keep versus give away? And now that we have this high exclusion amounts, it might just be better not to do as much estate tax planning because of the step up in income tax basis that would occur on death that might not occur on the death of the grantor of the slat. Divorce, as you said, is a big deal here. Treat the spouses as separate clients. Let them know about the possible ramifications here. In that same vein, detailed engagement letters are good to have. The idea of they can have their own separate representation if they would like, and encourage that to the extent that their goals are not on the same page. And then again, discuss the possibility of divorce and try not to make them exactly the same. Make those slats, if you're going to do reciprocal slats, make them significantly and materially different enough to assure that they won't get uncrossed by the IRS. I don't know if anyone has any final parting comments. I think we've gone through much of the material we wanted to today.
Yeah, I'd like to thank my partners here for carrying out while I enjoy my flu bug. And we're going to be giving a much more substantive presentation on this for the Tampa Bay Area Estate Planning Councils. If you're a member, I hope you'll see us at that event. If not, we will probably do a more extensive What We Learned at Heckerling Part 2 for those of you who attended this one. That'll be in about a month. I hope everybody has a fantastic day, and thanks very much again.